everyone, all my subscribers and viewers. Today we will be talking about inverse fair value gaps. What are they, how to use them, and which ones should you use? We are on the day 4 of this bootcamp. The 3 first videos should have shown you at least the basics of what is market structure and how to read it. Now we will be going in depth and getting to understand reversal patterns through the inverse fair value gaps. So let's get on with it right now. I'll show you an example of what it is. I'll show you the bearish inverse fair value gap first. So we were bullish here, alright, created this fair value gap right here, which first was a BISI, right? A buy side imbalance. We came back into it and retested it, right? Since we closed under the inverse fair value gap, you're looking for a retest of the fair value gap. So this became an inverse fair value gap right there. Since it became an inverse fair value gap, you want to get a retest and go back down, or if you can't wait for the retest, because sometimes the inverse fair value gap will get closed under, but you don't get a retest to get into the trade and get your profits, right? So a lot of the times what you should do is just take your trade here, stop loss above, and you take your trade wherever your take profit should be. So as the moment that the candle closes, you get your trade in, and the next candle comes in and you get your trade, right? So that's what a bearish inverse fair value gap is. You get into a buy side imbalance or sell side imbalance here, close under or above, and after that you want to get a retest. So you want to get this and go back down, right? Or like I just said, take your trade, go down or go up after the close of this candle or this candle. Okay, so that's the example. I'll now show you a more in-depth example of what it should look like. So here's a bearish example for the market structure of an inverse fair value gap. Alright, so here we started our move bullish, went back and retested the fair value gap as I said in the previous video. Get your break of structure, still in a bullish market structure, come back into this fair value gap, continue, break a structure, then you get your market structure shift as I've said before. So this becomes a strong high, we will not close above, right? You had this BISI here at first, which gave us a fair value gap, but when it became a market structure shift, which means we closed above here, below here, this became an inverse fair value gap, right? So we waited for the retest, got a break of structure. Normally you get inside here, stop loss a bit above the high, and your take profit is going to be at the next liquidity, right? Then I just put the sell side imbalance because a lot of the times it's just going to give you a good displacement with a fair value gap, right? So this is the bearish example. Here you have your bullish example, alright? So sell side imbalance, you get lower low, lower high, break of structure into a lower low, you get your fair value gap, retest into it, which makes it lower high again, lower low. You had your SIBI here, which was supposed to be retested in and just going back down, but we're not gonna do that here. So you got your market structure shift here, and since we got the inverse fair value gap here, where is it? Where's my inverse? Oh, there it is. So we got our inverse fair value gap here, since we closed above, retested, and got our displacement above with the break of structure, right, plus the BISI. So either you enter here, as I've said before, you enter into the inverse fair value gap, get the low, and target the next liquidity, Or what you can do is get the reaction off of the inverse fair value gap, get your breakout structure and your fair value gap, or supply and demand here, order block, right? You wait for the retest of either this one or of the order block below and coming back up, right? So that's what the inverse fair value gap template is. I'll show you a live example right now of how it works. So we're now on EU. I'll go back since we don't really have a lot of information on this market right now, but we'll stay here for the first examples of what an inverse fair value gap is. Alright, so we'll be looking at EU right now. We're in the same day live examples, alright? So it's not cherry picked, it's not anything like that, it's not me going back fucking a year before to try to find an example that works. Inverse fair value gaps are everywhere, okay? So here we got our sell side imbalance. We see we have not tapped into it yet, no taps, okay, didn't touch it, so it is still not mitigated. And when it is not mitigated, it means that it's still valid, right? But look what happened here. We violated the sell side imbalance, and we're gonna create that inverse fair value gap here, okay? Where is it? Oh, perfect. Perfect! So we got an inverse fair value gap now, retested into it, and continued, okay? So your first take profit would have been here. You get your trade here, stop loss here, take profit there, stop loss under the inverse fair value gap, okay? That would have given you a 2.67 because you are targeting highs and lows. Highs and lows are liquidity. Liquidity is where the market wants to go break that, and I'm gonna say a bad word here, but fuck the retail traders, alright? Literally, but fuck the retail traders, because they want to fuck your stop loss, alright? They want to come, take your stop loss, and then give you your movement, right? So the high here got taken out, and that's what our first take profit was, right? Second take profit would have been used with the standard deviation, but I think here would have been really my close. I wouldn't have taken the rest of this. This would have been my close. I would have taken 2.66 times my money, and I would be happy with that. Never be greedy. Greediness is what blows your accounts. I myself have blown multiple accounts because I was too greedy. Never be greedy. When you see your take profit get hit, if you want to, just scale your trades. So take 50% of your trade, take 50% of the profit, put your stop loss in break even. No risk there, and you took 50% of what you needed. Let the price move its way, and then you close your trade. But that's the safe way, all right? If you want to be unsafe, put your stop loss there, let it there, and let ride move or something. But personally, I tell you, just when you hit your first TP, scale in, and you'll be all right. Okay, scale in, stop loss at break even, and you're happy with what you got. So that's what an inverse fair value gap is. Okay, I'll try to find another one right now. All right, so here is another inverse fair value gap. All right, same example as before. It's the same place that before inverse fair value gap was there, but this isn't exactly just an inverse fair value gap. It became a BPR when two fair value gaps overlapped each other. Okay, that's gonna be into another video, but this is still an inverse fair value gap. Okay, you got your inverse fair value gap here, inverse fair value gap there, closed below, retested into it, So when you saw the price rejected off of it, you would have gotten at this one. Here, since the stop loss would have been really, really big, we would only use 50% of the inverse fair value gap, just a bit above, because we also add this SIBI, right? So two fair value gaps overlapping each other is a high probability trade, all right? So put your stop loss there and take profit. You use the manipulation here, manipulation block, which is an order block. You just use this candle with the standard deviation, and the -4 and -3.5 are your smart money reversal areas, all right? So smart money reversal, take profit is going to be here at the -3.5, so you get 2 times your money here. Okay, first take profit is going to be the -2 and -2.5. So either you scale in at those, or you let price go its way without the break even. Risky? Yes. Do I want you to do that? No! Never fucking do that. At the -2, if your take profit is at less than like a 1 RR, just tell yourself that your entry is not really the best entry you could have gotten, okay? So at the -2, you scale in, you do whatever you want, but personally, with this type of RR, this trade is kind of shit, okay? I'm not gonna lie to you, it's kind of shit. But it's still an example, a good example of what an inverse fair value gap is. So the inverse fair value gap, if you haven't understood yet, is a really great way to spot a reversal into in the market, right? So yes, we had this market structure shift here that gave us our reversal, but this inverse fair value gap would have been more of an exact entry, right? Since after this market structure shift, we don't really get any like real moves, right? You wouldn't have gotten a real entry other than this one, which got into this order block, okay? You wouldn't have ever gotten an entry on this SIBI, since we never tapped into it, as I said before. This inverse fair value gap got tapped into, so you could have entered the trade instead of just waited out all this time for nothing, right? So let's find another example in the past this time, because we really don't have a lot of information on this. Alright, so here is from Friday of last week. If you find the inverse fair value gap, congratulations, you've understood this this video, but I'll show you now where it is. Alright, you get your inverse fair value gap here. Why is it inversed? Because here we closed above the fair value gap. We don't have any supply and demand here, so what would be the best way to not supply and demand, but we don't have any real order blocks above here, right? So we know that price wants to come back up. We were bearish, we have all these fair value gaps to fill up, so we know that we'll be bullish, right? And keep in mind, this is on the M15, so you get some pretty quick setups. It's not like you're trading on the H4 or H1. You can get some pretty quick setups. All right, so you can have 2 to 3, even 4 setups a day if you want to be risky about it. But I'd say that normally you should trade maybe 2 or 3 times a day maximum. All right, do not overtrade. Overtrading is also one of the problems you can have as a trader. It's one of the mindset things that you have to think about. Okay, so overtrading is literally one of the ways that you doom yourself in Forex and indices and cryptos. If you overtrade, you overrisk, and when you overrisk, you lose, right? So we had this inverse fair value gap here. Why is it inversed? First of all, it was a CB, but then we closed here. Closed above, came back in. I wouldn't have taken my trade here, alright? Because we are in a ranging market, okay? A range here. When you're in a range, you do not look for a trade yet, because you do not know what it's gonna do yet, okay? You can't really like take any trades here because you would have gotten your stop loss hit here, would have gotten your stop loss hit here, stop loss hit here if you took like a sell trade on this one. You know, you don't trade into a ranging market because it's really good at taking your stop losses. It's sort of like search and destroy, okay? So it wants to reach your stop loss every time because it's in a contraction. But then when you get your distribution, now you're happy with what you have and you can get a trade because you know that there's volume coming in a bit of time. Okay. So here's our ranging market, or support resistance for support resistance traders. Here we get a real close above. Okay, we don't get wicks, we don't get shit like that. We get a real close above the fair value gap. So now it became a confirmed inverse fair value gap. Then you get your your consequent encroachment here. So the 50%, you wait for a retracement, close above, and here what do we get? We get a small close above this candle. What does it say? What does it mean? It means that's a low probability order block. So after getting rejection from this inverse fair value gap and this close, you get your change in state delivery, which is an order block. But you want to get this. No, get your candle here. CSD. So order block, change in state delivery. It's different for everybody, but I call it change in state delivery. I like it better that way. So you have your consequent encroachment. Take your trade at the consequent encroachment, right there. Stop loss below that low here. Okay, why is that? Because we got this inverse fair value gap that we might tap back into again, or we want to go take the liquidity of this candle here and just go and take like 50% of the wick here. Okay, you want to target the next liquidity, so you got this liquidity here, the high, and you got this liquidity here. Okay, and let's zoom out a bit to see if we have any more liquidity. We got this one, and we got this one, and this one. Okay, now what do? We use the standard deviation right there. What level correlates the most with the liquidity? All of them. So you got the -1, which is at this liquidity. That would be your break-even point. So once we close above that line, we become a break-even trade. All right. So we become a break-even trade. No risk in that trade. If you want to scale in, take like 50% of your trades, you can do that also. Then you got your -2, your -2 zone. You want to go and take that high there for the liquidity. That would have been your second TP. If you want to scale in here for your 50% and not do it here and just do the break even at this point in time, you can also do that. And then you got your smart money reversal level here, which got broken out of, probably because I didn't put my standard deviation right. Like that. Yeah, that was it. Perfect. So yeah, sorry guys, I put my standard deviation wrong. That was the manipulation leg for the standard deviation. I'm quite sorry. So -1 here would have been your break even. That would have been your real break even. Okay, we're gonna close that. That would have been your real break even. So at this point you're at break even. Then you get your -2 here, which is the next liquidity. If you want to go and take the liquidity here, you can also do that. then you have your 2.5, which is exactly at a liquidity level. So that would have been my take profit. And then you have your minus 3.5, minus 4 SMR area. I hope we'll be getting there, but personally I probably would have closed at the minus 2 even, because when you see a retracement like this, whether you like it or not, your mentality will like endanger the trade for you. So when you see a big retracement like this, you're gonna get scared, and you're probably gonna close it. And even if you close it when you're like out here, you're still at like a 1 to 4 or something like that. Yeah, you're like at a 1 to 4.6. So even if you close here, like right there, it's still a good trade. It's still a good trade. You take your profit, it's still a good trade. But since this is the minus 2.5, minus 2, and minus 3.5 are rejection areas, then that would have been the end of my trade, in my opinion, at this minus 2 or this liquidity level. Alright, so those are the kind of trades you can get with the order blocks and inverse fair value gap and highs and lows as liquidity for take profit levels and how to enter the trades. We are done here for the day. I just wanted to do a quick video on what is an inverse fair value gap, how to use them, and that's pretty much it. We'll be seeing each other in the next video, I hope. If I don't see you again, have a good day.